Going against the grain. Welcome to this week's edition of the Industry Leader Update by Reverse Focus. For years, we have heard both of the promise and the potential the retiring baby boomers hold for the reverse mortgage industry. And while this potential and rapidly expanding market is somewhat tempered by increasingly high mortgage debt held by those 62 and older, there is an overlooked niche within this group, the mass affluent. A recent Huffington Post blog entry entitled, "When Even Wealthy Homeowners Are Using Reverse Mortgages, the Question Is, Why Aren't You?" It speaks to the so-called mass affluent who can almost retire comfortably. Now, first is a sobering fact. Nearly 25% of those aged 50 to 64 have not saved a penny for retirement. Beyond that, those who have saved may not have saved enough, with the median balance of retirement plans standing at a paltry $120,000 or $400 a month adjusted for inflation. Then there's the mass affluent who have several $100,000 in retirement savings, yet will use a reverse mortgage to supplement their income in a down stock market. Barry Sachs, a California tax attorney and author, said, "It's a misleading term because they're not massively affluent. Rather, there's a mass of them who, and they're almost affluent. And that means they have $750,000 to $2 million of net worth at retirement." While conventional wisdom has long held that reverse mortgages are for the house rich and cash poor, the affluent stand most likely to benefit from a reverse mortgage. In recent years, several publications have noted the strategic use of a standby reverse mortgage, most notably those from Dr. John Salter in the Journal of Financial Planning. As an industry, we have long focused on those needing increased cash flow or who want to eliminate their monthly mortgage payment, while at the same time overlooking those caught in the middle between little or no cash and being independently wealthy. The standby reverse mortgage allows those invested in the stock market or equities to draw from the HECM line of credit during market downturns to avoid selling a depreciated asset and generating their retirement income. Then later, as their portfolio recovers, they cease withdrawals from the HECM and resume taking cash flow from their investment accounts, and in some cases may even pay back their previous withdrawals, allowing their line of credit to grow more quickly for future use in the HECM. Another good advantage is the omen that the average home value of the moderate or mass affluent, those with a net worth of less than $1 million, typically have homes which are near or below the current FHA national lending limit of $625,500. At one end of the scale, we have the needs-based borrower who may benefit in the short term, but possibly be at risk of default once their proceeds are depleted. And at the other, the truly affluent with more than adequate retirement savings and resources and homes that are well over the lending limit. Now, between these two extremes lies an opportunity that should warrant the attention of every reverse mortgage originator and lender. Now, what are your thoughts about the so-called mass affluent and their potential to grow our market? Leave your thoughts in the comment section below and have a great week.